couple months ago, I wrote a piece for our website and then recorded a video about a 3-bucket strategy for managing taxes on your investments. We'll call it a 3-bucket tax strategy. In summary, it covered how to use taxable, tax-deferred, and after-tax or Roth accounts to control your tax liability. In the opening of that video, I was inclined to point out that there are a couple of different 3-bucket strategies I've heard referenced from time to time by other financial planners, and I want to be clear on which one we're covering. As I did that, it reminded me that I'd never written or recorded anything about the 3-bucket strategy for timing that we'll talk about today. So whereas the previous video was the 3-bucket tax strategy, today we'll talk about a 3-bucket timing strategy, which is another way of saying we'll be addressing a strategic approach for investing based on when investments will be liquidated and withdrawals made from the accounts. Those 3 buckets are short term, which is 0 to 2 years, intermediate term, which is 2 to 5 years, and long term, which is 5 to 7+ years. We'll discuss the differences for each one of these buckets and why it's important to think about these 3 categories strategically. To begin with, let's talk about the importance of time and why timing the sale of an investment would matter in the first place. As you probably know, there are a near infinite number of ways to invest money, and all of them come with varying levels and types of risk. Now, our goal as investors is to find the best performing investments that don't extend beyond our ability to tolerate the risk that comes with them. For example, it would be foolish to use your rent or mortgage money to buy a handful of GameStop stocks on a whim because you might lose your home if the stock price takes a hit while you own it. Odds are you're going to set aside money for your rent or your mortgage in a checking or savings account each month because you know you're going to need it soon. Your risk tolerance for that money is very low. But what if you had no immediate need for the money? What should you do then? In that case, you should look into riskier investments that may produce higher returns, which brings me to another important point. For many riskier investments like stocks, risk and volatility tend to be mitigated or smoothed out over time. Now, as a completely random example, I pulled a pricing graph from Apple stock, and here's what it looked like today. Looks like it closed down a little bit, looks like it traded up and down, kind of bounced around a bit through the day, but it really didn't fall a whole lot. It was down less than 1% on the day. Now let's take a look at that same stock over the last month. You can see less volatility. The price, again, this is part of because of the scale of the graph, but it's a little smoother, and it does go up overall over time, but nothing really exceptional here. And finally, let's look at the stock over the last 5 years. Here you can see the volatility pretty well actually captured in the graph. But the stock price climbed quite a bit over 5 years, 268%, which annualized is going to be what? 55.6%, something like that. What I want you to notice is how the trend over 5 years, the long term in this case, shows a steady incline, while the 1 month and 1 day charts have larger fluctuations in price relative to the length of the time in the graph. In other words, the amount the stock fluctuated from the starting point of the graph. To put it in perspective, here are the annualized returns for each of those ranges. That's the 1 day, 5 day, and 5 year ranges. If that 1 day that Apple had the negative return was annualized over the course of a whole year, their stock would go down negative 229.32%, which is obviously impossible. If they had the same returns they had over that 1 month window, it would have been a 94.44% annualized return, which basically means Apple would nearly double in a year, which also seems unlikely. And then finally, over 5 years, Apple was up 53.72% annually, which is really stellar. It makes me wish I'd have bought Apple way back in 2019. Now, Apple probably wasn't the best choice for this example, but it still supports the point that long-term ownership of stocks tends to overshadow the day-to-day volatility of the same stocks. Now, taking the same example a step further, if you purchased an S&P 500 index fund at the close of one trading day and sold it at the close of the next trading day, there's a 53% chance that you'll receive a positive return from that investment and a 47% chance that you won't. Now, that's better odds than a coin flip, but not by much. But if you held that same S&P 500 index fund for a full year, you'd have a 76% chance of earning a positive return. And if you had held that S&P 500 fund for at least 7 years from any point after 1978, it never would have lost money. Never is 0% of the time, which means 100% of S&P 500 index fund holders who held for 7 or more years since 1978 made money on their investment. Now, to be clear, that doesn't mean you're guaranteed to make money if you buy and hold an S&P 500 index fund for 7 years. There's no guarantee that past results will translate into future success. But it does mean the odds are heavily in your favor when you hold stocks for a long period of time. Now, the point this illustration is meant to make is that we can probably afford to buy and hold more volatile investments that produce higher returns like stocks if we have the ability to own them for a very long time, like 5 or more years. It also shows us that owning stocks for shorter periods, say anything under 5 years, is pretty risky. In other words, there are compelling reasons to strategically align the timing of our monetary needs with the investments that we own. Okay, with that out of the way, let's talk about two primary timing risks. We covered all the previous information about market risk to lay the foundation for two other key types of risk that our investment portfolios are constantly exposed to. The first one you're familiar with is inflation risk. Inflation risk is exactly what you think it is. It's the risk that the value of our money or assets will be reduced by the steady increase in the cost of things we want to buy with that money. Said another way, inflation risk is the risk that our dollars will buy less and less in the future than they can today. The other primary timing risk I want to talk about is sequence of returns risk. Sequence of returns risk is the risk that you will need to liquidate your invested assets, typically for retirement, during a significant market downturn. So having to sell invested assets at a low point can have a devastating effect on your portfolio and its ability to last through your expected retirement. The goal of a three-bucket strategy is to mitigate both inflation and sequence of returns risk by thoughtfully constructing an asset allocation that will produce steady enough returns to outpace inflation while not simultaneously exposing your assets to a sudden, devastating market correction. Let's talk about how each of these three buckets will help us do that. To begin with, we want to talk about the short-term bucket. That's 0 to 2 years. Now, the primary purpose of the first bucket is liquidity. The funds in this bucket must be accessible quickly in order to cover immediate needs like emergencies or expenses in retirement. No matter where you are in life, you need some money in this first bucket. The amount you need to keep in this bucket will vary depending on a number of factors, but it all starts with calculating your monthly or annual spending needs. If you haven't done a budget in a while, at least kept track of your regular spending, you'll need to do that in order to fund this bucket. Once you pinpoint your regular spending, you need to evaluate how many months of those expenses you may need to cover with bucket 1. If you're working and have a stable job with no plans to retire anytime soon, 3 to 6 months of expenses should do the trick. A lot of people also refer to this as an emergency fund. Now, if your work and your income fluctuate because you have a seasonal business or you work in sales or some other reason, you should plan to hold up to 1 year of expenses in this bucket just in case you have a bad year. For those of you who are already retired, 2 years of expenses is the minimum I would keep in bucket number 1. On the other hand, if you have regular dependable income from another source like Social Security, a pension, or some other business, then you can reduce the amount you keep in this bucket by the amount of regular income from that source, assuming it's reliable. So for example, if you spend $100,000 each year, but $30,000 of that is covered by Social Security, then only $70,000 of each year would need to be covered by bucket 1 because Social Security is a reliable source of income. The primary object is to ensure you either have income diversification or a full bucket number 1 to ride out extended periods of unemployment, low cash flow, or high expenses. So where do you put the cash that's in bucket number 1? Well, with an emphasis on liquidity, the options for putting this money in a place that will generate substantial returns is pretty low. You want to look at savings accounts, short-term treasuries like 90 days or less, money market accounts, money market funds, certificates of deposit, things like that. Personally, I have mine in a money market fund offered by the custodian that handles my personal investments. Right now, in the spring of 2024, it's doing really great because short-term treasuries are really high at the moment. But the benefit is it's highly liquidable, it's easy to access, and it provides a little return for the cash that I have in case I need an emergency. By the way, if the information in this video is helpful or useful to you, please consider clicking like and subscribe below. That will allow you to receive notifications whenever I post new videos. It actually helps my channel to grow. It'll allow me to keep making videos like this so I can keep teaching people about personal finance. The second bucket is for that intermediate term, that 2 to 5 year window. And the strategic goal of bucket number 2 is to find a happy middle ground between the unimpressive returns available for cash and cash equivalents and the more exciting earnings obtained through stock ownership. Now, with this money, we can afford to limit our ability to liquidate the balance for some time, but we can't afford to expose it to a downturn in the stock market that may last several years. So retirees or those who are approaching retirement stand to benefit the most from this bucket, as it's used to provide income for 2 to 5 years down the road. But that doesn't mean only retirees can use it. Almost everyone will have some major expense they can see coming 2 to 5 years down the road. Maybe it's the purchase of a home, maybe you want to do a renovation, maybe your kid's going to college and you want to help fund their education. But once again, it's for expenses that are 2 to 5 years down the road, so the amount that you hold in this bucket should be for expenses that you expect to use 2 to 5 years from now. Now, the assets you hold in bucket 2 will generally be a little different than those in bucket 1. The overwhelming majority of the time, the bulk of the assets in bucket 2 will be in high-quality bonds. Bonds normally provide access to sufficient yields while also uncoupling you from many, but not all, of the market risks that are inherent in stocks. With that said, as I'm recording this, the yield curve on bonds is a little funny. So short-term bonds are actually yielding more than long-term bonds. So that's kind of a weird situation where you might flip it. But generally speaking, the shorter-term bonds will return less than longer-term bonds. So Just note that it's a little different right now. But no matter what you decide to buy here, don't take chances with low quality or junk investments that you hope will produce higher yields. You don't have time to expose this bucket to difficult price depreciation. Another way to look at it is that we're not really looking to introduce more risk in bucket 2, but we can give up some of the liquidity. I'll also point out that many of the securities I've just described tend to also be income producing investments. If possible, try to hold these assets in a tax advantage retirement account like an IRA or 401k instead of a taxable brokerage account to avoid the tax obligation they produce. On the other hand, if it's in a retirement account, you'll have to wait until age 59 and a half to access those funds. So if you're saving for an expense that's 2 to 5 years down the road and you're under 60 years old, then you're going to have to find an investment in a taxable space so that you can actually use it. Personally, I've just found it easier to overstuff bucket 1 than to fool with bucket 2. In fact, there's another video which I'll link where I explain why I don't own any bonds at all. That's sort of applicable in this situation, but I'll put a link to that above so you can check it out if you like. All right, the last bucket is the long-term bucket, and that's for investing money that you won't need for 5 to 7 years or more down the road. Now, there's some people who would argue that you should expand bucket 2 to a 2 to 10 year range and push bucket 3 out to 10 plus years down the road. There's nothing wrong with being more conservative if you want, but I think 7 years is plenty of time to protect yourself against a market downturn for a few reasons. The first reason is that while there have been market recoveries that have taken more than 7 years, they are rare and they generally only apply to market segments that a broadly and properly diversified portfolio would avoid. I want to share this table with you from Morningstar, which basically illustrates different market downturns and how long they've lasted. Be sure to note the type of investment segment that they're referring to when you see market recovery. A lot of this is like gold or small caps or very, very small focused segmented stocks where a broader portfolio would probably be able to ride out these sorts of downturns. I'll put a link to the article where this chart came from below in case you want to look at it more. The second thing is market downturns are always measured from a single point in time to another single point in time. And they're always measured to show the longest possible recovery period. You'd have to have astonishingly bad luck to buy all of your long-term investment assets at the worst possible time. Now, odds are you will accumulate many of your investments over a period of months or years. Now, whether you mean this as a dollar cost averaging strategy or not, spreading out purchases reduces the risk that you'll buy at the worst possible time. And finally, the only timeline long enough to guarantee yourself that you'll avoid a market downturn altogether is the one that never begins. If you're concerned that the stock market is going to run into the ditch with your assets and never get out again, you should just stop at bucket 2. But don't cry to me when your friends have more money than you do. And that brings me to another point. You know what else is great for bucket 3? Assets you don't ever need. Now, there are a few of you out there who have done such a stellar job saving you can't possibly spend everything you've managed to accumulate. There are even more among you that could spend it, but you won't because it doesn't make you any happier to do so, and you'd rather leave the money to your kids or charity or some other beneficiary. Since the timeline of these assets is indefinite, you might as well leave them where they have the greatest potential for growth. As for what assets to hold in this bucket, you should own a globally diversified group of stocks in some form. Mutual funds and ETFs are the most convenient way to acquire and hold these assets, but be sure you buy low-cost index funds and ETFs so expense ratios aren't eroding your earnings away. Now, which funds you buy is up to you. The easiest approach would be to buy a total stock market fund like VTSAX or VTI and just be done with it. You could also buy a variety of large cap, mid cap, small cap, international funds, etc. to provide broad exposure. REITs would also provide exposure to real estate, but I don't think those are entirely necessary. But whatever your approach, be sure that you're using strong years from bucket 3 to refill buckets 1 and 2 as needed. Rebalancing every once in a while will ensure that you're taking gains off the table when the market is up, while also ensuring that you won't have to sell from bucket 3 when the market is down. So as you've been watching this, you may have thought to yourself, this sounds a lot like basic asset allocation. Well, you're right, because that's exactly what it is. The typical approach to asset allocation is a simple ratio of stocks to bonds like 60-40 or 80-20. Slightly more sophisticated approaches include a number for cash like 55-35-10, or even commodities. You could do like a 50-30-10-10, but I wouldn't recommend that. Another common rule of thumb is to subtract your age from 100 and whatever the remainder is. You should own that percentage of bonds in your portfolio. Now, honestly, you could do a lot worse than this, but the two best justifications I can make for selecting ratios like these are 1, they force you to rebalance, and 2, they're very simple. And if that's the type of asset allocation you want, go for it. In many cases, less is more. Simple is better. Now, I'm not being critical of the approach. It's a challenge to get anyone to invest anything, much less think about an asset allocation that's appropriate for their unique spending needs. But it's also true that you only need the amount of stocks or bonds that match your expectations for when you will spend the money. Well, if you want something that fits your situation specifically, That is to say, you want a portfolio of assets that more precisely is arranged to meet your real needs for the money, then this 3-bucket approach is a great way to go because the liquidation and use of the assets matches your expectations for using it. It's customized for you. What could be better? And truthfully, you can geek out on financial strategies in perpetuity. Money is fungible and time is always introducing change. This approach may or may not be for you, but by all means, just have an approach. And for more about investing, check out our investing playlist. We have a lot of other playlists on our YouTube channel. It's also martinmoney.com. I recommend reading through that if you have time. As always, we are grateful for your interest and time watching our videos. God bless and take care.